Hello fellow traders, the ability to identify and use key levels for trading is definitely one of the factors that distinguishes profitable traders from unprofitable ones. And this technique of technical analysis is based on a simple concept that is easy to understand, but it's difficult to master. So today we will continue the series of analysis of binary options market and reveal a little secret that will help you find the best market turning points. And of course, if you missed the previous videos from this series about indicators and patterns, take a look at the description under this video after watching it, of course. But for now, stay with me, and today I will tell you how to reduce risks and start making successful deals at key levels. Okay, so first of all, let's talk about what key levels are and why is it so important to find them on the chart. In this case, we are on a currency pair euro-dollar, and it's really important to understand that typical retail traders almost have like no influence on currency pairs like euro-dollar because you need a lot of money that they typically don't have. The price is influenced by big banks and institutional traders. Let's imagine that we definitely know that tomorrow at 1 p.m. one big bank, one important bank is going to sell something for a couple of millions of dollars. I don't know. What we need to do, we need to wait for the price to go down. And this is a great tactic for trading, to trade with the big bank. But there is one problem. It's called inside trading and it's illegal. It's really illegal. So the key levels actually give us almost the same information as inside trading. They give us the understanding when some of the big organizations or institutional traders or like a huge number of retail traders will do something on the market. So in this case, what do we see? We see that the price was growing quite a while and then went to this level and dropped back down. Why did this happen? We need to understand that if the price made such a huge jump and then went back down, we have a reason for that. In this case, it's a really interesting reason, and this key level is actually simply psychological level. So the price went to this level and then it went down, but look at the price in this moment. The price was exactly $1.12 per 1 euro, which means that when we see such psychological key levels, that means that a lot of traders, institutional traders, banks, they were coming in like lower points, and they thought that the enough profit for them is going to be at this exact level. Of course, not all the movement and all the decisions of institutional traders can be predicted by you, but a lot of them can be, just looking and using simple techniques. And psychological evaluation is one of those. Let's look at other types of levels. In fact, most traders rely on 3 types of levels. Firstly, these are support and resistance. Horizontal levels where the price has difficulty moving up or down. Support is a level from which price bounces up, and resistance, as an example that we have analyzed before, it bounces down. Next one is trend line. Diagonal lines showing the general direction of the market up or down. They connect highs or lows and help predict the price in a trending state. And the last one, of course, Fibonacci levels, which although not a key level as such, they are still often used and they show excellent results. And these are mathematical levels based on Fibonacci sequence, and they help to determine the points of price correction after the impulse movement. In this video, we will look at how to graph and use all of these levels correctly. But in the meanwhile, if you find this video useful, please like it and share it with your friends. Your likes and comments really help our channel grow and create even more high-quality content for you. Don't forget to subscribe and click on that notification bell to be first to know about the new video coming up. And of course, there is still a lot more interesting things ahead. So let's look at the support and resistance levels. Horizontal levels in which the price behaves like a ball, bouncing off the floor, which is support level, and the ceiling, which is resistance level. Most often using this type of level, we try to find confirmation that when reaching it, one of the other side was interested in the past, and we assume that they are still interested in it. Imagine that we open a chart and we see this kind of picture. What information can we get from this? The price went to this level, dropped down, went to this level, dropped down, went to this level, dropped down, and again, it is coming back up. So what do we understand from this situation? We understand that there is some, not even some, a lot of different sales, and reaching this level, the price was dropping after. Also, you need to, please don't forget that support and resistance lines, they are not simple lines, not a thin line. You need to understand that this is a zone, and even if you use a line, use like a thick one. So we understand that in this zone, the sellers are activizing. And what we can think about that, we can think that when the price is going to get to this level again, the sellers are gonna, move again, and the price is going to drop, which is actually happening. But what else is important in this case? Here we see that the price dropped to this level, went back up, dropped to a kind of similar level, and went back up again, and again dropped the third time. That means that the buyers were interested in the price. And we understand that the price reaching this level, which happened right now on this candlestick, the price is going to go up. But you can see that the price actually dropped even lower. And what does that mean? That means that there was not enough for us to connect a couple of dots and call it a key level. Key levels can be tricky a little bit, and they can, just be invalid. And let's look at how we should do that correctly and find good key levels. When I'm trying to understand how valid the level is, I'm trying to have like three criteria. First of all, how many times this level actually worked. For example, in this case, we can see that the price went here once, twice, 3 times, 4 times, 5 times, and the 6th time are really close to each other. So this worked 6 times at this point, and the buyers are quite interested somewhere in this zone, right? And this is our first confirmation. Also, I really love to remember that support levels become resistance levels, and when that happens, that means that the level of support or resistance become even stronger. So for example, here, if you look a little bit behind, like in the past, you can see previously this zones, before the zone started as a resistance zone, it worked almost like 3 times as a support zone, after which it was broken through and became the resistance zone. This is the second confirmation. And the third one is a big movement of the price. For example, here we see that when the price moved down, there was like a really sharp turn down, and here we have the same situation. And that means there's not just a lot of buyers and a lot of sellers, but they are actually quite big to move the price in such a manner. And in this case, I have all 3 confirmations that this zone is valid, and let's see, the price is actually working with the zone again and went down. Same goes to analyzing the support level. So for example, in this case, we have 1, 2, 3, and the 4th touch of the level. So the price worked 3 times already before. And in the past, we can also see that this level worked as a resistance level as well. And of course, from here, we are expecting the price to go up, and the level is going to be valid, which we actually see right now that we were correct. But in this situation, it's a bit more complicated because we would expect the price to sharply turn back up. We see that there was a lot of confusion on the market, what's going on. And it's really important to understand that the ability to find the level that works, it's not always enough to close the deal with the profit. And how to use this level and how to use all the levels in your strategies, I will talk about a little bit later at the end of the video, after we talk about 2 other types of levels. If we talk about pros and cons of these levels, let's of course start with advantages, and one of them is entry accuracy, as they help you to identify good moments for opening a trade with a high probability of successful outcome. And another one is understanding the market, because those levels allow you to understand where the big players are placing their positions. And now disadvantages, and first of them, false breakouts. The price can break through the level and then quickly return return back, which can lead to losses. And another one, experience is required. Beginners often do not correctly identify levels or even use too many levels at the same time, which leads to incorrect analysis and errors, of course. Okay, now the second type of levels, this is a trend line. It's a great tool for understanding direction of the trend, and when the ascending line is drawn through the rising lows, it serves something like a diagonal support line, and vice versa. When the descending line is drawn through the falling highs, it serves kind of like a diagonal resistance. Of course, when the price reacts to the trend line, it confirms the strength of the trend and makes it possible to open a deal in the direction at the best price. When we are using trend line, when we're opening the chart, we see that the price is in the trend state. So for example, right here we have an uptrend, and maximums and minimums are being updated, and higher highs and higher lows are being created. And for us to draw the trend line for an uptrend, we need to connect our higher lows. And of course, the line is going to be drawn under the chart, connecting all the lower dots. Let's see, what else do we have? Yeah, the trend worked a couple more times. Let's continue the line. Oh, and what do we need to pay attention to? First of all, of course, trend line is the same as support and resistance line. This is not just a line, this is a zone, and it's completely normal when the price goes outside of this line slash zone and sometimes not even reach it a little bit. It doesn't change anything because again, it's a zone and not just a thin line. Besides that, what do we have from trend line? First of all, of course, understanding of the trend. First of all, understanding that this is an uptrend. This is a really powerful uptrend. It's obvious. And of course, we know that each deal that's going to be open for a downtrend is a really bad idea, and we're going to lose money. So of course, we're going to try to find entry points for an uptrend. Obviously, again, everything is so obvious. And where are we going to look for entry points is on the trend line itself. So if we're thinking about it as a support level, then we understand that when the price reaching the level, the trend level, this is the zone for someone to buy products, right? And we have the same rules, and we can just simply find those dots, like pullbacks, and we can earn money from that. All of my strategies, my main strategies, built on pullbacks that is easy to understand and easy to see on the chart. And of course, trend line, as in any other level like a resistance, it is not going to be forever. At some point, the price is going to break through the trend line, and after that, there is going to be either consolidation or the new trend. For example, right here, this is going to be a downtrend. And of course, let's look at the example with the downtrend. Here we see that the price is updating its minimums and creating lower highs and lower lows. And our task here is to draw the trend line and connect our lower highs. We connect all the top peaks from which the price is actually impulsively moving down. And of course, it's just same as a support and resistance line and an uptrend. It's important to understand that the price touching the trend line doesn't always mean that the price is going to go down. For example, in this case, we see that at some point trend line was broken through. And as I said at the end of the video, I will show you how I find specific entry points and make a decision to enter into a deal. And it can not only be based on the level, it gives us the main idea where potentially we can have the entry point, for example here, down. Also, let's highlight the pros and cons of trending along the trend line. Let's start, of course, with positives. Number one, it is simplicity, since the trend is the most often easy to see and put a trend line on the chart. And next one is, of course, as the opportunity to open deals in the direction of the trend at the best price. Now let's talk about the cons. Number one, ambiguity. Depending on the selected points, that trend line may be different for different traders. So it's always necessary to double check the chart in order not to miss the key points. And number two, inefficiency in the sideways market. In the absence of a pronounced trend, the lines are ineffective and they will often break through. giving you false signals, obviously. Before we move on to the Fibonacci levels, if you want to understand more deeply the use of key levels and learn how to apply them in your trading strategies, I invite you to join my free online academy. There you will find detailed lessons, practical tasks, and get support from me and your supervisor. The link is, as always, in the description box down below, and I will be glad to see you among my students. And now, let's continue. Let's look at Fibonacci levels, which are designed to help determine where the price may stop after the correction. Fibonacci levels are based on a golden ratio, and levels that are more used in trading are 38.2%, 50%, and 61.8%. Fibonacci retracement is a great tool that gives us the ability to do almost the same as the trend line. And that means that we can enter into a deal with an uptrend and do it at the best price. So usually I use it in the cases where I cannot use the trend line. For example, right here, we can draw the trend line like this, like so, and we would be kind of correct because we connect this high, and this high as well. And after this, we have the trend being broken through, and from here we cannot enter into a deal for a downtrend, obviously. Or we can say the trend line is supposed to be drawn like this. And from this point, of course, we kind of have the idea that we can enter into a deal for a downtrend, but at the same time, it's not really correct because we completely ignore this high. So the trend line doesn't work here, and instead of that, I use Fibonacci retracer. For us to use it, we need to connect with the tool our recent high, with our recent low. And you need to include the tails / the shadows of the candlestick as well. And you need to see how the price is going to react to some of the levels of Fibonacci. And the levels are drawn by the lines, but you understand it's like 0, 23, 38, 50, blah, 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 and 100%. Which we talked about already. And in this case, what do we have? The price is doing the potential pullback from here and haven't met any resistance anywhere. And we need to see what's going to happen next. And we kind of notice that the price is reacting to the level of 0.5, so 50%. And our first candlestick happened there, but the price went back up again. And what we see next, we see that from the same level, the reaction actually happened. And from this point, we actually can think about entering into a deal for a downtrend, and we are correct right here, and the Fibonacci level 0.5 worked. Same goes to using Fibonacci with an uptrend. For example, right here we connect our swing low with our swing high, and we see that the price is reacting to the level of 0.38, so 38%, and the price is moving upwards. And if the price actually reacts to the level of not golden hour, right, not 38, 50 or 61, but it goes lower, me personally, I don't work with that, but many traders still work with 78%. But I don't really think this is like a correct way to trade. And if the price is breaking through the level of 100%, I definitely completely refuse to work with that, because the probability of price to do the reversal point, it's really small, because the change of character happens, the structure breaks, and the price can go even lower. In fact, Fibonacci retracement is actually a really interesting tool, and I have a separate detailed video on it, so we won't go into much right now. And if you want to learn more about these levels, I will leave a link in the description box down below, so check it out for a Fibonacci video. And in the meanwhile, let's move on and talk about pros and cons. So, of course, we will start with positives. Number one is versatility, because Fibonacci levels help to identify potential reversal zones after a correction, even in absence of obvious trend line. And another one is flexibility, because it can be used on trends of any strength. Now let's talk about the bad side, and the biggest one is, of course, multiple signals. Sometimes Fibonacci levels can create confusion due to large number of potential pivot points, so it's necessary to use an additional confirmation method to filter the signals out. Now let's talk about how to effectively use key levels in strategies. And in my main strategy, I use both key levels and patterns with indicators. So I think it will be a good example right now. My strategy is based on pullbacks. So first things first, what I need to do, I need to find a good quality trend. And in this case, I found currency pair, euro and Japanese yen. And then, of course, I need to add my key levels. And obviously here, I'm going to use our trend line for an uptrend. And based on this knowledge that I have with my eyes, from this point, potentially I can find our price reversal. Second element of analysis is going to be candlestick patterns. I'm waiting for candlesticks to show me that in this case, bulls are taking the power over the bears, which gives the price impulse movement to break through the level and get higher. And of course, let's see what's going to happen to candlesticks. We see that the next candlestick is engulfing candlestick, which we talked about this pattern in the past video, and definitely should watch it. But this candlestick shows us that after a price drastically dropping, it pulled back to the next one really again drastically. And it's a really good pattern. Combined with the key level, it shows us that the price is probably gonna rise again. And the third confirmation for me is indicator, and my favorite indicator that I use most often is stochastic. So in this case, we see that stochastic also shows me a good signal. The blue line crosses the orange one, and the indicator goes through our oversold area and moving upwards. So basically, in this case, I have all three confirmations with all the key things of my analysis: our key level, our candlestick pattern, and our indicator. And only after I get all three elements of confirmation from three different types of analysis, from here I can enter into a deal. And of course, this one is going to be for an uptrend. I work with 3-minute expiration time, and in this case, you will see that my deal would be closed in black. Let's summarize the results. Key levels are an important tool for a binary options trader because they help find optimal entry points, reduce risks, and improve accuracy of your predictions. And of course, I think for maximum efficiency, it's necessary to use an integrated approach. So combining key levels, indicators, and patterns in your analysis. And in previous series, we have already discussed candlesticks and price patterns. And if you haven't seen those, then make sure to check them out because all of these three topics are closely related. And that's going to be it for us for today. Thank you so much for watching. Subscribe and click on that notification bell so you won't miss any of my new videos, and I will see you in the next one. Bye bye.